Caroline is the director of and chief change catalyst of Huru Consult Limited, a Nairobi-based management and training consulting company that has supported entrepreneurs locally and internationally since 2008. She is passionate about strategy, governance, finance, leadership, and personal development and services and serves on the boards of the Association of Startup and SME Enablers of Kenya, that's ASSEK, and the Kenya Association of Women Business Owners, that's KAWBO. Yeah, so ladies and gentlemen, let us put our hands together for Caro. I want to believe all of us know how to. Yeah, she has been here before, taking us through strategy. For those of you who are able to attend that, so she's not new to this platform. Yeah, thank you very much, Caro. You may take it on. Thank you.
Pleasure to see everybody, and really excited about this. Thank you. So today we're looking at investor readiness, and I know this can be a pretty complicated sounding topic, but I want to make it as simple and as practical for all of us so that we really know what it takes to be ready for investment and also to attract investment. Because it's not always about us as entrepreneurs looking for investments, but it's also about taking the notice of the investment community and having them actually approach us. So we're looking at the question, is your business ready for investment? And just a bit about Huru Consult as we get started. We are management and training consultants, and we've been running our business since 2007. My background is in banking and finance, where for a number of years I was a corporate analyst, and then moved on to becoming a large corporate relationship manager, looking after key accounts. So analysis and investment is right up my alley, as well as just giving advisory to businesses. So that's what we've been doing of late, where we analyze the entrepreneurs that we work with and we help them to develop strategies to improve themselves. And our latest offering does include helping them to become investor ready. So we've done assignments both local and international, mainly focused on, as Edna says, strategy and governance, organizational development, entrepreneurship, finance, personal development as well, and learning and development. That's another key service that we provide, where we train trainers, we train coaches, and we train consultants as well. And our slogan is freedom to be, freedom to grow. We say, come as you are, but don't stay as you are. You must grow under our hands. And that's our slogan. So what we're going to look at today is for us to, first of all, just lay the groundwork with a good understanding of business investment. And then there's a checklist for investor readiness I'm going to share with you. We'll have a number of conversations around that. And then most importantly, what are some of the actions you need to take? It's really about going back to basics and building an excellent business in the first place. And this will enable you to outline key considerations for you to be ready for investors, and then also to explain the pros and cons of investor financing. It's not always rosy. It's important to think that, and also to consider the pitfalls that exist both for you and the investor and how to navigate them. But ultimately, you'll be able to improve your business in order to attract suitable investment partners. And this will help you by having clarity on the requirements and the process. Also, it will be paramount for you to actually improve your business tremendously to attract the right investors, and then also your business will grow and you yourself will also grow. Because just going through the investment process demands a lot of you. You must grow in your leadership, you must grow in your communication, you must grow in your management, but ultimately it's good for you because as you're learning and growing, so does your business do so with you. Thank you.
Somebody else.
Okay. All right, there's a bit of a noise. All right, good. So let's go straight into it by asking ourselves whether our businesses, just to help us gain the foundation, So let's just type in chat, what finances have you sought before? And I know we're talking about equity investment. Equity investment is where you add capital in your business or somebody else does. So we're talking about this broadly first. Have you sought investment before? Was it debt? Was it equity? Was it a grant? Because there's also grant financing. And were you successful? And what did you learn from the process? So let's have us typing our answers in chat so that we can get the room warm and a bit of engagement going there. Thank you. Have you before? If you have, just type Y for yes. And what kind of financing was it? I know for most of us it's debt, but some of us may have already looked for equity financing. So you can share that. And were you successful? You can just type, because we want to use the shorthand, you can just say, so here's an example. Y, equity, successful. So you just type the words successful or unsuccessful, and then you can just type operations are key as an example of something that you learned, or record keeping is a must. What are some of the things you learned? So let's keep it brief and short. But let's see, yes. So Melvin, yes, debt, finance, learned that you must have good security. Thank you, Melvin, for setting the tone. That's how we want to do it. And I see others have come in as well. Catherine, debt, business hasn't picked up, so you're struggling to pay back. Okay. So what's the lesson there, Catherine, if any? Thank you, Jeremiah. Equity, not successful. What lesson did you learn, Jeremiah? The lessons we gain, whether we're successful or not, are always so important because they speak to what then we do in future. Edna, debt, successful. Still, Edna, with your success, what did you learn? Melvin, debt, I think I read that already. You must have good security. Zachary, successful, finance. Yeah. So what type of finance, debt, equity, or grant, Zachary? And what lesson did you learn? As I've gone through life, the most important thing is what you learn, whether you're successful or not. Very important. So those who have requested to add that, please do. Anton, you're saying, yes, equity successfully crowdfunded. Brilliant. That's a wonderful testimonial there. What did you learn, Anton? Maybe you were nervous at the beginning, but you learned just go for it. Nancy, debt and successful, properly kept books. By the way, that's a foundation. Absolutely. Thank you, Nancy. Zachary, equity. So tell us what you learned from that, Zachary. I think you'd already weighed in before. David Ndago, yes, loan successful requires discipline. Yes. Tell us a bit more about the discipline, David, because you're right. Excellent management is what attracts investors. We can be really fancy, with our storytelling, but at the end of the day, the rubber meets the road in how we're running our businesses day to day. Thank you. Catherine, more of challenge. Salary, security was a salary, but you're no longer in the job. Pandemic closed some opportunity that was to help to pay up. Yes. So what have you learned out of that, Catherine? Thank you. And then Edna, learned importance of understanding total cost of debt. Yes, because there are hidden costs. And you also, if you're looking at going into investment partnerships, you also need to learn really what's the total, what will it take out of you, what is required of you. And not only to look at the money, but also to look at many other factors, as we shall discuss as we go along. Thank you very much. So sources of business financing. Okay, I see one more thing has come in chat. Learning to be resilient. Yes, Catherine, as long as you're alive, as long as you're breathing, you can do something, right? There's always a way out. And one of the things I said when I started as a consultant, and I still say to date, there's no problem without a solution. And so keep interrogating, keep searching until you land on it. You will land on it and then implement it. Thank you. Good. Some more patient capital. Yeah, equity is critical for long-term. Yes, patient capital is the capital that doesn't demand a return immediately. The investors are willing to wait for a long period of time to get the return. Thank you. Thank you very much for that. As such important contributions, even as we are getting started. Brilliant. So This is basic, but I'm a trainer, and I think I have the anointing of a teacher. So I like to just lay the groundwork because we could have a mix in our audience, right? We could have those who are just beginning, those who are really experienced. I saw Maurice among us and others. And so it's important to do that. Sources of business finance, you can do it yourself. So out of your savings, selling assets as well. Then also you may have another business that is cash rich. So you may take some money out of that to invest in your own business. Family and friends, let's not eliminate them. Either they can lend you money or they can invest in your business, but then also you can borrow from your cooperative society or from banks. Banks are among the formal lenders or microfinance institutions, but what we're going to talk about today is investment, yeah? So, and this is not really about your friends and family investing in your business, but really looking for people who are out there with money to give to businesses that are worth it, to help them to grow and scale, and therefore to gain a return on investment. And so this is why people's businesses look for financing. They want money. If it's startup to get off the ground, or they're very early stage to get off the ground, to really move, gain traction, as we say in the business, and then to scale. So it could be startup capital. It could be working capital, which is the work that you need for the day-to-day running of your business. In relation to this could also be trade financing. So either money to purchase stocks or money to keep your business going as you're collecting from your debtors. So those are examples of trade finance. Or it could be for capital expenditure, money for investment. You want to move into a new location, put up a building with the machinery, etc. Or you want to buy a farm, do the planting, etc., and get it up and running. Or it could be you want to go into new markets. So these are some of the reasons why entrepreneurs seek investors. If you have a different reason than the ones that I've mentioned here, please type them in chat. As you can see, our session is going to be highly interactive because I really want to hear also from you in terms of how this is landing and whether it resonates with you. So if there are any other reasons why you do type your responses in chat. And then also, we want to access finance now. So rather than wait to grow our business organically, we also seek investment financing because we want the money now, which enables us to circumvent time value of money. You know that over time, money loses value, but if you can get it now and put it to use now, then you gain that. And then, as I've mentioned already, access to markets. But another key reason is access to expertise. For instance, if I'm an agripreneur, so basically I farm, and that's my business. So I'm in agribusiness. And so I have all this produce that I need access to market for. There are some organizations that will help to fund you, provide you with your inputs, etc., and actually then buy your produce off you in order to sell either within the country or outside the country. And then they'll also give you expertise on that particular type of farming. And so you can have access to expertise. And then also overall, just access to management expertise. People who are strategists, people who are financially sound and able to just professionalize your business and help to build it up. One thing I'd like to stress right now is that it's a two-way, and it always has to be two-way. As an entrepreneur, don't always feel that you are at the receiving end and whatever they say you must do. But a healthy investor-investee partnership is always one of give and take and one also of mutual respect. Thank you. Anton, yes, R&D, absolutely. Product development and taking the new product to the market, absolutely, because you're tapping into expertise. And one series, actually programs I encourage you to watch because you learn so much out of them, are programs like Lion's Den, that was local, sponsored by KCB, but also internationally Shark Tank and Dragon's Den. Because you see very often the entrepreneurs want to partner with somebody who has some expertise and or somebody who has access to markets. And yes, as we've been told in chat, R&D is a big part of that, as well as product development and taking the product to market. Yes, thank you for that. And thank you for also enriching our discussion. So sources of capital, we've talked about this briefly, but there's you, friends and relatives. We've talked about that as well. Earlier on, broadly, when we're looking at sources of financing, but now this is specific for investment, right? So there's you could inject capital into your business, and then your friends and relatives could buy shares, and these are known as personal investors. But now going out of your personal network, you could look for angel investors who are mostly interested in startup or young companies that are looking to grow, and these are known as seed investors. Or you could go big and look for venture capitalists, right? So they would give startup capital with long-term growth potential, but initially a large amount is needed. So these are larger ticket investors. And of course, they would be looking for normally a business that has very high long-term growth potential, or one that is already demonstrating that, right? And so what investors look for ultimately is return on investment. And mostly it's a financial return, but also there could be other returns which are non-financial, like investing, let's say, in women businesses or in youth businesses, or growing a particular industry or sector. But primarily, it's all about the money, right? And so they're looking for that return, but they're also looking to give back in other ways. Thank you. So specifically, this was Abigail Johnson, who's an American billionaire businesswoman. To put it as simple as that, returns matter a lot. It is our capital. Why? The more they get returns, of course, that comes into their pockets, but also it gives them the ability to invest again in future as well. So they're looking for a return. What are you looking for? It's important to be very clear about that as well. So just as we also get deeper into this, it's important to also appreciate that there are pros and cons, and we need to take those into account as well. So some of the pros, of course, is that you get money, right? So there is financing, but you also get access to expertise that you otherwise would not have. You're able to grow your business as an organization. So organizational development in terms of systems, in terms of structures, in terms of management expertise. And then you also, as I mentioned earlier, you grow. You yourself grow as a leader, as a manager, as an entrepreneur, but your business also grows. And then you have access to networks because your investors very often will come with access to networks that you otherwise would not have been able to access. Access to markets, as we've seen before, research and development, which is part of the expertise we were talking about. And then also, there's no monthly payment or interest expense because it's not a debt, right? And there's no need to pay back if you are bankrupt. Of course, there's a risk that the investor undertakes, and there's, of course, a risk on your side as well. But ultimately, if things don't go well, and typically they would go well, but of course, sometimes they don't go well, you don't have to pay back. But of course, there may be some damaged relationships there as well, especially if the investors feel that it's your fault, or vice versa. Some of the cons is that you do relinquish ownership and control of your business. In some toxic situations, you might find that the investor comes and literally takes over your entire business, and you just end up having a management role. So those are some of the things you want to think about even as you're doing this. And in your business, I mean, they're right in your business, yeah? They're not only in the living room or in the veranda outside, they're in the kitchen and in the bedroom. So it's about also being able to open up to them and just understanding that that's what it takes. And then also the focus, there might be a focus or a priority mismatch. Your focus and their focus and priorities are misaligned. So that could happen. I also sometimes talk about DNA. Your DNA and theirs, that means your values, may actually have a mismatch. So as they're doing due diligence on you, it's important for you to also do due diligence on them and ensure that your interests are protected as well. There's also risk of duplication, that they come into your business to learn about your business and then go and do the same business elsewhere. I've already talked about risk of takeover, where they take over everything in your business and you're left with very little and sometimes even nothing. And then, of course, you have to share your profits and the future benefits. and it takes longer sometimes just to onboard and have access to the financing simply because of the thorough due diligence that is undertaken by good investors. They really make sure that they understand everything about your business. They come in, they strip everything down. They want to know the ins and outs to ensure that yours is a viable investment. Thank you. I'm heading over to chat. I see some comments have come in. Okay, so I see already we have a few questions that have actually come in. We shall be tackling them at the end, so do keep them coming, as well as your comments. I appreciate feedback as well. So yeah, think about it. There are pros, there are cons. So don't just go rushing to any investment opportunity that you see. I see them always being posted on WhatsApp groups, etc. Check out the investing company. If there are entrepreneurs in your network who've worked with them, buy them a coffee, find out about them, what the experience was. If the experience has been good, and if you do your own checks and you see that, yes, it's viable, go ahead and do it. But just understand that there's a lot of work required on your side, and that your investors will also be doing a lot of due diligence on their side as well. Okay. So just to introduce this in terms of, is your business ready for investment? That there's a checklist that they use. And the most thing that I like to tell entrepreneurs is that good quality businesses attract financing, whether it's investment financing, debt financing, or even grant financing. And so the onus is on you to ensure that your business is attractive. Let me say that right at the beginning. And then let's look at the process just for you to understand what happens. Normally, there's an invitation, or there are some that do it round the year. So you apply and you're picked. And of course, you have to have an excellent business plan. And I know we talked about that a bit when we did our session on strategy, that you have to have a plan, and it has to be in writing, and it has to be viable. And then you also need to prepare a pitch deck as well. And of course, if somebody is working with you, as we would in Huru Consult, we actually help you with all this. And sometimes investors have their own templates. And so find out what's needed as you're applying. Use their tools if they've provided you with tools. So don't say, yes, me, I have mine. I have my own that I've done. No, use theirs, because there's particular information that they want presented in a particular way. Among the links that we'll share with you after this, there's actually a standard pitch deck that has been developed by Guy Kiyosaki, and he calls it the 10 slides that you need, that helps you to really focus the information. But I'll tell you, as a finance person, the most important, as somebody who has sat in so many pitches, the most important information is the market information, of course, the leadership information, but also your financial story. Both your historical and what the future looks like, and your ask. Those are very, very important. But yeah, there's application and selection, there's your business plan and your pitch deck, and then you prepare for investment readiness. And talk to any person who helps entrepreneurs prepare for investment. This is where the real work is. Because if your records aren't in order, if your taxation, if you're not tax compliant, all those are things that investors look at. If the team is not a strong team, you have a weak team, let's say there's only a single founder, or the founders don't have the capacity, or there's 2 or 3 founders, but only 1 or 2, only one particularly is running the business, normally those are red flags. And so there's a lot of inner work that needs to be done, developing the team, creating the systems, the structures, ensuring that there is market traction as well, and many other things. So there's a lot of work that goes in here in terms of really getting ready. And we'll talk about that in the next slide. And then there's pitching. And no matter how good your business is, if you're not able to present it effectively, you might end up losing just here. In the pitching, the way you're presenting yourself, the way you're presenting your business, it's really important to do it right and to pitch in the language that the investors understand. And so the due diligence includes confirming that all that you're saying is facts. So normally this comes after the pitching, where they're like, okay, they want to look deeper into what you're offering. A key element is also your governance and your business model. They look at that as well. And then the risks for this investment vis-a-vis other investments and other things that they look at here. After that, if it's all systems go, then you go into creating a term sheet. A term sheet is simply a summary the terms and conditions of the investment that they're entering into with you. And of course, you look at it on two sides. So make sure that your interests are also covered here. And then there's negotiation about the terms of the sheet. You finalize those, and then you come up with an investor agreement that is signed by both of you. And then among other things, of course, the investment period is agreed there, and the levels of investment according to terms. And then as you go now into the investment, it's enforcing those and making sure that things are happening according to the investment. And of course, there's monitoring and investment. And then there should be, and there usually is, an exit time. So normally the exit period is defined. It could be 5 years from now or whatever period it is. And normally at that point, for many organizations, many businesses, it's a point of concern, but it doesn't have to be, because one, you could seek other investments. Two, you could ensure that you are stable enough to actually carry on once they exit. And so plan also for the exit, because it will come, and then look at the options around this period in order to do so. So this is an entire journey. And of course, it starts with the application and the selection. Thank you. So moving on. So what are some of the things that need to be considered? And these are considered by investors, but remember, you need to think about them as well. Values alignments, sectoral alignment as well. So maybe you're in manufacturing, but they're looking to invest in agribusiness. So there would be a misalignment there. So you want to do your homework and find out what's available. But there are some who are sector agnostic. That means as long as a business is viable, they're willing to invest in it. What's hot right now is basically climate, agriculture, things around environment and sustainability, and also tech. There's a lot of those are sectors attracting a lot of investors right now. That being said, as long as your business is viable, you could still attract investment. Again, very key is viability of the investment, proof of concept that there's a market, that your product works, that there are people who are interested in it. You're attracting people who want to buy it as well, and that you have sold and you've made a profit. So all that is under proof of concept, which is aligned to your business model. Market traction is that there's potential in your market to grow, but already you've begun to make some inroads in your market. Very key is the management, the leadership, the management of your business, and then the level of control that your investors would have. Of course, they want to be on the board. They want to be where decisions are being made. Sometimes they even come and are involved in management, day-to-day running of the business. And ultimately, they are keen, as we've seen earlier, to return on investment. Now, this is very key. It's a checklist I found recently, and I've been looking at this for a long period of time, but I found this very useful checklist by Seedstars, which just outlines the key elements that are looked at by investors. And so starting at the bottom, they look at the people, they look at product and market, technology and operations, revenue and growth. I'll unpack them. That's why I'm going a bit rapidly. Don't worry. Financial and performance management, legal and admin, and finally, fundraising. And this is where your ask is, but also what the future of your business looks like financially. So going one by one, with the people, it starts with the founders, that is you. And it's all about who are the founders, how many are they, first of all, very, very important. And ultimately, yeah, I made a handout here, a brief one. Yeah. So who are the founders, the team, and ultimately also who's the CEO, who will be running the business day to day. Typically, they like businesses that have 2 to 3 founders. And so if you're by yourself, even if you can prove, it may be a good idea to look for a founder. And the handout, it's a booklet. So the booklet that will be shared with you to download is able to link you to places where you can get the information you need, right? And so basically, if you're alone, you may want to consider getting another founder or building a very strong management team. But typically, the businesses that attract investment are businesses that have at least 2 founders or more, and that you work together, that you complementary. And then the emotional intelligence of the CEO is also very, very, very important. When we come to look at market and product, what you're selling, that there's proof of need for that product in the market, and then also that you are able to hold your own against the competition, that you have a clear advantage that is difficult to replicate, and that you know what the barriers to entry are, and that you're aware of the market size, and that you have good acquisition channels. That means you've got a good pipeline and you're able to attract customers to your business, attracting purchases in your business. And then also the product that you have, does it fit the market that you've chosen to play in? So all very, very important considerations around product and market. Technology and operations also important. Number one, does your business run efficiently and effectively? Do you have an in-house team, particularly if you have, what's the level of automation in your business? And is your solution scalable? Scalability speaks to automation, but it also speaks to the team that's running in terms of your systems and your structures in your business. When it comes to revenue and growth, it's about a few technical words. One is your your customer acquisition costs. Very important to know what it takes to acquire a customer, where you look at your marketing costs and you divide that by the number of customers that you've obtained in a period of time. And then there's also how well you're selling your business, but also, and if your sales are going up and increasing, and then also the lifetime value of a client. For every client that you're getting, what's the lifetime value of that particular customer if they stay with you for life? And then do they also remain with you, or do they just come and go? Very, very important, because revenue comes out of the sales we're making, and it's important to be able to analyze them to that level. With financial performance and management, we're looking at whether you are tracking in your business. Remember, we talked about management, and then also how you're managing cash flow and what challenges you have around that, particularly debt collection. With legal and admin, it's about the legal structure of your business. Are you a sole proprietor? Are you a limited company? Are your returns up to date? Are you tax compliant, etc.? And equity that you're planning on giving away. So for instance, when you watch programs like Shark Tank, they're very, very, those who are good, the entrepreneurs who are good, are able to say that we are looking to give 10% of our equity, or 20% of our equity. And sometimes the sharks want more, or sometimes they want to have a revenue share. So it's very important to think about that, including the equity you're planning on giving away. Typically, as an entrepreneur, you want to maintain the higher percentage than the lower percentage. With fundraising is that, yes, you're pitching for funding. How are you planning to raise funds? How much of that is your own? So the more skin you have in the game, the more interested they will be in, because they're understanding that you're sharing the risk. And finally, what type of financing are you looking for? Does it come only finance, or there are other elements included there? And the look and feel of your pitch deck. So how you pitch is also very important, and we shall be looking at that just now as well. So remember, you can type in any questions you have, but this in a nutshell is really what investors will be looking at, starting with you and the team, and of course the CEO, the person who's running the business day to day, the product and the market, technology and operations, revenue and growth. The financial is key, as I said, as well. So the money coming in, the business growing, profitability, cash flow, also very important as well. And there are metrics that are analyzed to help with that. Then, of course, the legal and administration, and of course, the fundraising. So how much of your business will they own? How much are you willing to give? Will they also be involved in the running of the business? Taxation and other compliances, licenses, etc. also come in here. And of course, how you're intending to raise the funds and what it will be used for as well. Thank you. So understand that pitching is key, and this is what you need to help your potential investors understand during your pitch. But understand that most pitches fail, and it's really, really sad. And I agree that it's really low because of the pitches I've listened to, and I've done that since 2021. You find that there's a lot missing in terms of the information. And as a finance person, a lot of the financial, you can have all these beautiful pictures and all these lovely stories that you're telling that really touch us emotionally. But at the end of the day, it's about the numbers. And as we say in finance, the numbers don't lie. So only 1% of pitches attract investors and land investment money. And this was information I got from Inc.com. And it may not necessarily be 1% across the board, but let's agree that it's really, really low. And so you want to get into that really low number of those that attract investors and land investment money. And I hope what we've been discussing today is helping with that. So why do they fail? Because, and I didn't say this, but I know this already, half-baked financials. So your financials don't say the whole story. There's information missing, and it always boils down to what I tell entrepreneurs: keep records. Keep all your records, not only financial records, your people records, your operational records. Just get the discipline of keeping records, because if your records are good, and you keep them well, then you'll be able to extract the financials, right? The idea that you have might be unproven. So you've got these wonderful ideas. They don't bank on ideas, they bank on proof, right? And then also the team might be weak. And these are the main reasons why they say no. Unproven idea, half-baked financials, and a weak team. Okay, so when it comes to the pitch deck, it needs to be clear. So using a template helps with this because you're simply filling in the details. I have done an investment readiness course, and what I find helping is that being able to tell the story in a logical way, and normally it's good to provide the pitches that you need. So they need to be very clear, well-structured. They need to sell you, the leadership team, and your business. And the ask needs to be very clear. You find many entrepreneurs will go through the pitch, but it's not very clear what they're looking for. They're looking for debt, they're looking for equity. How much are they looking for what period? It's not very clear. So make sure there's a clear ask, and make sure that you're selling you and your business. That is there for emphasis. You're selling all the time. And so even how you communicate needs to really be convincing. Your passion needs to come out, but also just your clarity in terms of management needs to come out very clearly as well. So you need to allow time to prepare. So thorough preparation is key, as is also research. You need to research your market. You need to research your the investors. You need to also ensure you're providing comprehensive information. Use pictures, both your own. So it's good to have your own pictures about your business. For instance, if you're processing fish, you want to have pictures of your process line. It's very useful to do, of the people with the fish, of a happy client even. So just have nice pictures that you're taking that you can post on your website, but of course include in your pitch deck. Make sure you prepare so well that you have time to rehearse. Sometimes, of course, you're nervous, and that is normal. It is said that nerves help you do a good job when you're pitching. But also, I know from experience, the more you pitch, the more you do it, the more you do your presentations, the easier it becomes. But never, ever become lazy and complacent. Every pitch needs to stand on its own and needs to really convey what the information that your potential investors are looking for. Okay. Very good. So let's see. Okay, there are questions that have come in chat. Thank you. So let's continue with this as well. Okay, so a few points to note, very important, is first of all, you have to build a very high quality business, because there's so much competition now for the funds which are available that investors really have their choices of businesses, and they'd rather hold on to their money than put money after a business that is not a quality business. So you have to convince them as to the viability of your business. The other thing is about the leadership of your business, the management ability of your business model, clear strategy, key, excellent people and operations, and of course, a viable business in terms of the market. Other important elements are high governance and review mechanisms. So not that you have a strategy and you're not reviewing, you have to have reviews and measurement going on as well. Other things is that you need to network, you need to get out there, you need to be where this information is flowing as well. One organization that does this a lot as well, you need to find out also within your industry where the investors are, and to make sure that now you're engaging with them. A good place to start is the East Africa Association of Venture Capitalists. It's a good one, and there are others as well. And then also pitch. You network, you pitch. You have to stick your neck out, ladies and gentlemen. Get out there, pitch, do your own due diligence. I've mentioned this already before, and ensure that your DNA matches. Negotiate. Don't be just the one that they're saying you have to do this and this and this. Also, agree on what you want as well. Negotiate the terms and make sure your lawyers go through the documentation and ensure that you include non-compete clauses and non-duplication clauses as well, at least for a period of time. Of course, you can't lock them out forever, but at least for a period of time, ensure that those are there. As I said, let your documents be reviewed by your lawyers. Read everything. Don't feel pressured or pushed to sign immediately. Understand what you're getting into and read everything. And so we've looked at understanding the business investment environment, and then we've also looked at the checklist for investor readiness and the actions you need to take. I'll share these references. You want to really study this investor readiness checklist. It's the one I shared as a triangle, because the information contained here, especially if you're right at the point where you want to get into this, is pure gold. Amazing reading with links to other links that you can read. So make sure that you download this tool, but also watch on Shark Tank, because these are just examples of pitching, what goes well, what doesn't go well, learn from them, because your ability to come across strongly as an entrepreneur is key, but also your granularity with your numbers. Being able to articulate your numbers, is very, very important as well. And then I've also included in the resources, the only 10 resources you need in your pitch by Guy Kawasaki. It's just a template based on Canva, but it will help you to know the different things you need to think about. So those are my contacts there. So feel free to get in touch. I hope the team has been collating the questions and comments, because I saw them coming in very fast. I know once I began presenting, I missed a number of them, but I know we're about to go into the Q&A, so we'll do that. So do get in touch in case you want to discuss this further as well. But just remember this, whether you're seeking financing or not, intentionally work on your business. As entrepreneurs, we owe it to ourselves to create excellent businesses, because the more excellent businesses, whether you're building your business organically or looking for debt or equity financing, you will be attractive to financiers if your business is an excellent business. So that's the parting shot I want to leave out with. Otherwise, is to say thank you to everybody and welcoming your questions and your comments. You can type your take home in chat as we go to the questions. Thank you. Over to you, team, who are moderating the questions. Thank you.
Thank you so much, Caroline. This has been one of the greatest presentations you've ever had, and what a great way to continue coming to the close of the year with great insights. I think we have quite a number of questions at that session, if not many. If you haven't typed yours, kindly you can do so. And if you'd like to speak it out, you can raise up your hand and we'll be able to let you speak and ask.
Okay. I remember seeing one earlier on from Melvin, so maybe we can begin with that one. Yes.
I can help you get the first one was from Irene.
Uh-huh.
That is how best can sole proprietors attract investors, especially trustworthiness in the area of governance and leadership with respect
Yes.
to that. Yeah.
Okay.
And yeah.
So maybe I can take
Then
two or
I don't know if
three.
you want.
I can take two or
Yes.
three and then I answer them. Yeah.
Then there is one that came from Martin Olo. A single founder so disadvantaged. What about when you mention all other staff you work with as a team?
So
And
that's
then there is
related
one.
to the first one. And then,
Yes, related to the first one. Yeah. Then there is one from Patrick, and he is asking, what does proper due diligence entail?
Okay. Thank you. So I'll do that. And then just try to find Melvin's, because I think it was one of the first ones. It's early on. So you'll want to scroll up and do that. But meanwhile, let me answer these ones. Okay, so how best to do that? So what to think about it from the investor's point of view. You're the sole proprietor, you're the sole vision bearer of this business. And so what if something happens to you? Because one of the key things is risk management. If something happens to you, what happens to the business? It means that it will most probably collapse. It won't be able to continue if you're the only one. And that's why they look at 2 or 3 founders as an ideal. Sometimes, of course, they look at a higher level of founders. But if 2 or 3 of us are there, if something happens to us, and you know, life happens, guys. I mean, people pass away, people get sick, people are not able to be active as they were before in their business. And so how do we ensure continuity? It's just managing that particular risk. Not to say that a sole proprietor cannot attract investors, but what you'll find is that very, very quickly, you will be highly encouraged to get a co-founder. And in that handout from Seed Stars, there are actually guidelines on how to get a co-founder if you're a sole player. I know sometimes we want to run everything ourselves simply because that's how we started it, but you know, it doesn't have to stay that way. It actually doesn't have to stay that way. So that's so how best to attract investors. I think proof of the concept is key, the solidness of your business, but also evidence of the intention that you are looking to get a co-founder will really help to attract. And then, yes, single founders are disadvantaged simply because of that. Even in businesses, you find, I mean, in lending, you find that banks will ask you to take key person insurance. And then they will also take a critical look at your management team. So if you're able to demonstrate a very strong management team, the fact that everything doesn't lie on your shoulders, then you could get still attract some investment. It doesn't mean the door is entirely not open to you, but it means that there's more convincing that you need to do, more work you need to do to convince that your business will still be viable, even if you're not in the picture. I hope that helps to answer your question. What was the third one? I'm sorry, I didn't write it down in my notes. Paul Peter?
Yeah, the third one was what due diligence entails.
Oh, what due diligence entails. Okay, thank you. It's a really deep investigation of your business. So they, of course, they look at the leadership, actually all those areas that were in the pyramid, looking at the team, looking at the inner workings of your business, whether your business does do what it says it does, whether your business does make the money that it says it makes, and all that. So it's looking at really stripping everything down from your business to look at it almost with a magnifying glass to ensure that indeed this business that they're looking to invest in is all that it says it is. So that's due diligence. In short, your investors doing their homework on you to ensure that you're a viable investment. Thank you.
Thank you very much. Now, from Melvin. Okay, the first time he had just indicated that let's put our questions in the chat.
Yes,
but now
before
this
that.
is the question.
Yes.
Yeah, this is the question. Breakdown, quote, expertise as a reason to seek investors. Why is it, that is end of quote, why is it that any startup with a white face or faces get equity finance at a drop of a hat, even if it is for a solution we don't need.
Okay. So, of course, in every industry, in every sector, there are issues, so to speak, or politics. So I think it's a trust issue, but we know trust is not in the skin color, trust is in the heart, is in who people are. But also, again, expertise. So I'll start with the expertise. I may need to, let's say, access a new market. Let's say I'm in Kenya and I want to access, let's say, Nigeria, but I don't have access into Nigeria, right? So I might need to know how to get into a new market in a totally different country, and I might need expertise with that. And the investors that I'm getting involved with may have that ability. They've gone into new markets, like in 10 different countries, and so they have that expertise with them. So rather than me learning for myself, if I bring them into my business and they have a stake in my business, they will be able to do it for me. And I will learn through the process. So that's part of the expertise. Some of it might also be technical, perhaps. Being able to use particular equipment, particular machinery to generate the products at the level, at the scale that we want to. And so that's what I mean by expertise. But also, again, it could also involve leadership expertise or management expertise, being able to take a business from small to very big in a short period of time. In myself, I don't have that capacity, but if I engage with them, they will bring in that capacity and will be able to do it. And again, I will learn through the process. Then about picking investors who are white, I think it's really about a trust level or investees who are white. But one thing I know is that there's a lot of interest in Africa, and in Africa, we are Africans, right? So our skin color is black or brown, as the case may be. And so they're following the money, Melvin. So as long as you're able to prove that they can make the money, they're not really particular about skin, although where is most of the investment money coming from is coming from outside, although increasingly we are getting it from our country as well, from Africa. There are a lot of Africans now who are looking to invest in up-and-coming businesses and make money as a result. People like Ayisi Makatiani is one, and others as well. There's the Tony Elumelu Foundation as well that is always looking for potential businesses to invest in. And even here, I know I saw some information recently about women who are coming together to become angels and to invest in small and medium-sized businesses. So that interest is increasing as well. And there are associations now being formed of angel investors. And we have one right here in Kenya as well, right? So there's that. But at the end of the day, Melvin, money doesn't have a color. Money is about, if I put my money here, will I get more money back to enable me to put more money into other ventures? So that is key. Sometimes I think it's also about trust, but ultimately I know money doesn't have a color and money goes where excellence is. And there are a lot of businesses here, including one or two that I know personally, that have scaled simply because of building up, doing the work. By the way, it takes work to build up your company to something that will attract an investor. The hard work you have to do on yourself. But for those of you who are willing to do it, then it really is a route you can take to just fast track your growth. I hope that helps, Melvin. In case you have any further questions or comments on that, feel free to share them. Yes, but ultimately it's about the money, and there's a lot of interest in tech, as I said, in agribusiness and things which are climate and sustainability related. Thank you. Next questions.
Actually, we have run out of time. It's 8:15. I don't know, maybe you just answer one more.
Yes.
And then we close.
Yes.
There is one there are only two people who've asked further questions, but Martin has asked a good number of questions.
Yes.
There is one from Evelyn Equil.
Yes.
How do you protect yourself from an investor who is only interested to know your operations, but is not interested to fund you? Once they get your information, they decline the offer and go set up a similar business. Now that's really fundamental.
Exactly.
Yeah.
And we talked about that earlier. I mean, I think it's like marriage, choosing who to marry. There are people out there, yes, who look like they're good on the outside, but on the inside, they may not be the best people for you. And so you take your time too. Study them. And if you notice that they're only interested in things that they're interested in, but not in what you're interested in, then perhaps that may not be a good match. And don't feel that you have to be tied to them now and that there may not be other opportunities, because you know what, you've been running your business already. And so sometimes it's better to take more time to look for the right partner than rush to be with a partner who will end up being a pain and a headache further down the line. And very often, if you take your time to study them and not be so excited about the money, you can know that this one is a win and this one is not. Another thing I like to say, trust your gut as well. If you have a bad feeling about something, then don't rush into it, because you might find yourself with tears as opposed to laughter towards the end. Another thing I want to emphasize as well is that another reason for having two partners is that you think together. And so there are things that your other partner might notice that you might not notice. And it's good to also think about that as well in terms of having a co-founder or a partner, so that you're not thinking by yourself. But another thing that can help with that, by the way, is having a board, an advisory board, which can help you to think through these things. And that, again, will mitigate the risk that the investors have as well. So I shared my contacts. So in case you want to discuss this more, please do. But I think that was a good one. And then the last one here from Martin Olo. Apart from risk management, is there proof that business with multiple co-founders are more successful? I think it's really all about the risk management, but also the different expertise, Martin, that different founders bring. Because I might be really good in sales and marketing. Another one might be good in strategy and strategy implementation, or you might have another one who's really good with networks and operations. And so together, we then build synergies. Of course, there are issues with that. We've had issues where there's conflict amongst the partners, but as long as there's alignment in terms of the purpose of the business and the vision for the business, normally you'll find partners able to iron out issues. So it's not only about risk management, but it's also about synergies and leveraging on one another's expertise. Thank you. Okay, good. So I'll share my contacts in chat again for those of you who need them. And then right now, thank you. Just to say thank you. I'm very passionate about this, but also to say that investment is not the only way you can build and grow your businesses. Remember, there's others. But for those of you who are looking to go investment, I trust that this has been good use of your time, and that you're able to gain insights that you can use. And I'd love, love, love to continue the conversation. So just leaving it at the previous slide, so that you can take my contacts down, and over to you, T. Thank you very much, everybody. Have a wonderful day and a great week ahead. Thank you.
Thank you so much, Caroline. We are really grateful for sharing your expertise together with us, and be sure we'll definitely get back to you for more insight on the same. We have somebody to give us vote of thanks. Yes, you're welcome to give us a vote of thanks.